All right, point of today's episode, how business owners, and if you really, really want to be rich, how you can save for the future and how you can build wealth and riches without the traditional approach of what people think is the savior of the 401k, even though the 401k is the devil. We're going to talk a little bit about the 401k, but I want you to build wealth in a way that you don't have to put your money into prison for 30 plus years and then get penalized to take it out. So business owners especially either forget to save, don't know how to save, or understand the different types of money to be saving in. So most people might be thinking like, well, you just save in cash, right? Like a savings account, a forced savings account or anything like that. But I want to talk about different ways to do that. That way it's actually working for you and you're not at the mercy of it being held by somebody else, controlled by anybody else, because the answer to this is control. Like that's the best possible thing you can do is control your own money.
Wow. And I'm going to start this episode by saying what we say about 1,000 times an episode. Just kidding, but we have said 1,000,000 times. We do have an episode called The 401k is the Devil. I'm not letting him go on a tangent today.
No tangents today. I promise.
If you want to know why the 401k is the devil, go watch that episode.
Yes, I promise I won't go on a tangent. I know I have absolutely no like 40% throttle on that topic for whatever reason. I'm just passionate about it. It's because you have to attack poverty. You have to attack control. For anybody that defends somebody else controlling your money, you have to attack that. You can't just let it go. Because if that thinking is okay forever, everybody else will be rich and not you forever. The only reason I became financially successful is because I took control. If you want to break it down to the absolute simplest form, I took control. That being said, there are some traditional ways that aren't necessarily negative for your life or bad for your life or anything like that. I just think there's way better options, especially if you're a business owner such as yourself and or self-employed and or looking for further options to grow your money outside of like just what you're traditionally doing right now for whatever work that you're doing.
Granted, I was like 16 to 20 years old, but I actually had my business for like 3 years and I was like, oh, I have a business. I'm the boss. I am the company. How I don't have somebody else saving my money for me for retirement.
Yeah, you don't have insurance.
Yeah, it was like a realization. One day I woke up and I like panicked. I remember texting you. I was like, Todd, I'm not going to have insurance or retirement savings. Todd, what do I do?
Yeah, you texted me this at 19. Like I
said, granted, I was 19, but I'm sure there's people who run into the same situation when they're a little bit older.
Oh yeah, all the time. I mean, you can do a search across YouTube right now for "I'm 50 and have no savings." Well, when we did the Reddit question episodes, how often was it like "I'm 50 and I have no savings"?
So many, and it makes you question like, how do you get to that? How are you just now hitting the panic mode when you get like you're like 40, 50 years old and you're just now realizing?
Because it's not taught.
Yeah, but like you're just then panicking like it didn't cross your mind once. What am I going to do when I stop working?
Well, you're so advanced so early. It's actually difficult to explain how traditional thinking, because I was stuck in traditional thinking longer than you.
Yeah.
Like I was 25 before I really took control, right? Which is still...
This is your fault. You having to explain this to me is a consequence of your own actions because you taught me these things early.
Which is still 24, 25 to come to that realization, have that awareness
not late at all.
Super young still. I admit that. But before that point, like there comes a time where you recognize or realize, oh, the thing that I'm doing now won't get me to where I want to go, truly want to go. Sometimes that doesn't happen until you're 50. A lot of people don't ever realize that. That's why we have a job. That's why we have this podcast. And so what I want to talk about is how business owners can save. And there's a few different ways, in my belief, that you can do that. And you have to do it through a couple different types of money. You have to have equity in things. You have to have money working, cash, and really future investments. And when I say future investments, I don't just mean like, oh, I'm putting it into a Roth IRA.
I was going to ask you what a Roth IRA was.
A Roth, it's just a traditional retirement account. Okay. So anything Roth is you're taxed up front, and then after tax dollars, you put the money into the account, and then all the growth is tax-free. You're essentially taxed on the seed instead of the harvest, which I highly, highly, highly recommend over the traditional, like a 401k or just traditional IRA, just for the simple fact that you're taxed on the seed and not the harvest.
Yeah. Okay.
And the way that I can prove that to everybody right off the rip, are taxes higher today or 30 years from now?
30 years from now.
Absolutely. So why would you ever want to pay higher taxes on a future harvest of a higher number?
I was about to say that's like, yeah, okay, taxes are going to be higher, but the bigger thought is that why wouldn't you want to be taxing the $5 versus the $1,000 later? Like, yeah.
Right. Now, there will be people that bust out graphs and line charts and they're like, actually, because of the accelerated growth, because of the extra money you're able to put in, but you're really not, because in those accounts you are limited.
Yeah.
You're limited in how much you can put in to have the quote unquote tax benefits or tax savings, deferred taxes in a traditional 401k as an example. So to me, there's no point in that. And who I'm talking to right now is the person who wants to take control, the person who either has a business, wants to own a business, and wants to be able to save for the future and have some sort of consistency in their life above the age of 50. So whether you're 22 right now, 21 right now in your case, whether you're 22, 25, 30, 35, 18, 40, 45, it doesn't matter. What you can start doing is start implementing some of these strategies. That way, not only do you have access to your money, but the money is also growing. That's my whole goal in this conversation. So I'm going to start with real estate. Okay. And the reason I'm going to start with real estate is, one, yes, I'm known for it. But two, I believe it is the greatest wealth accumulator on the planet Earth.
Okay.
And the reason for that is that it is needed. It is a needed commodity. It is a needed problem that you can provide a solution to at all times. You can walk down the road right now and walk past more opportunity than you could possibly capitalize on without ever knowing it. That's how big the problem within real estate is. Now, I'm not just saying, hey, go buy a bunch of single family homes and rent them out, and then other people are yelling at you like, oh, that's why I can't buy an affordable home. It has nothing to do with that. It has everything to do with true value. Just like inflation and taxes, is it going to be higher today or in 30 years?
30 years.
So what's the value of a tangible item or asset going to be? Is it going to be higher today or in 30 years?
The value of it?
Yeah.
It'll be higher in 30 years.
It's going to be higher in 30 years. Even if the perceived or true value of it isn't any different, it's going to take more dollars to get there. So therefore, it's protecting your dollar.
Yeah.
So I'm going to also talk a little bit about how we actually run our money. I think people would be interested in that, how we actually branch our money out, okay, and have it go to work for us. So we have a specific amount that's designed for our own usage. So we forecast how much we're going to spend each month, how much we how we self-pay, how percentage-wise, where that money goes after accumulating to a certain level, all those things. We can talk about all those things, if any of that is interesting to you. So I'm starting with real estate because it is a holder of value, and it's very good at it. I'm not even necessarily talking about the cash flow aspect of it. Yes, of course, when you rent it out, it also pays you every single month, which is a benefit. But what I'm mainly focused on is building equity. Because equity does a couple of different things. One, it's basically rocket fuel for your net worth and capability and your ability to borrow in the future. Okay, so if you have $1 million in equity across a portfolio, any bank will work with you. You create options and opportunity for you in the future for other things that you want to do. Also, if you borrow against an asset, you don't pay taxes on that income because it's not income, it's technically debt. Now, does the asset need to be able to pay for the debts for you to comfortably live? Of course. Are there things that can happen that makes that more difficult? Of course. That's why you have to be responsible in this. But my whole point is that you control this thing. I want you to control your money. I want you to control the assets. I want you to control your actual future. So if you put money into real estate, whether it be single family, multifamily, commercial, I don't really care, to be honest with you. I see people in my industry successful across all different avenues. Some people will tell you multifamily is the only way to go. Some people will tell you commercial is the only way to go. Some people will tell you mobile home parks are the only way to go.
Somehow all of those people are successful.
Every single one of them has the ability to be successful and is successful.
Yeah, but you always say it depends on what works for you. Is like each individual person or company or whoever is buying it. Every owner of real estate is going to have a different niche because like what fits them and their needs and their lifestyle.
Exactly.
Yeah.
So I'm just going to use a round number of $100,000. Okay. So if you're saving $100,000 and you save it in, let's go over first a traditional savings account. After 1 year, let's just say inflation rate's normal, which is average 4%, you have $96,000. The second year, you lose another 4%, third year, another 4%, another year, another 4%. And you have this negative compounding effect. Now, your bank account will still say that you have $100,000, even if it's untouched, but it only has the ability after a couple of years to buy something for, say, 80. It only has 80 grand worth of worth. 80 grand of buying power, I should say. Now, if it's like the past couple of years, where inflation is not 4%, that's where you're going to really see a downfall and a struggle. And that's why you see things that are literally twice as much over the past 3 or 4 years as they were, just a handful of years ago. So if you save it in a traditional savings account, you're going to lose money. If you were to put that money into a piece of real estate, I'm going to take out appreciation. I'm going to take out cash flow. I'm even going to take out the tax benefits of it. I'm going to take out a bunch of benefits right there.
That's a really important part.
It's a hugely important part. I'm going to take out all of that.
Okay.
And I'm only going to focus on the value hold. This is how I think about money long term. It has to hold its value. If I'm fighting against its value all the time, it doesn't matter what I'm doing, I'm losing.
Yeah.
Just as a value hold, if you just use inflation, again, let's average it out 4 or 5% per year. I'm not even going to talk about the past couple of years where everything went crazy. If you have $100,000, in 1 year, you now have 104.
Yeah.
The second year, you now have 4% above that. Third year, 4% above that, and you have a positive compounding effect.
Now, imagine if you start with, you buy the house and you buy it, value at a discount, and you start ahead of that because you already, the house appraises higher than what you bought it for.
Exactly. Let's say you buy
you're not even accounting for that. That's what I'm saying. You bought it, say you even bought it and it appraised $10,000 higher initially than what you bought it for.
Let's say you bought it bad and you bought it for $5,000 more than what it's worth.
Even after 1 year, you're still you
break even, and then above that you're in the green.
Yeah.
Value hold. So if you're going to think savings, future income, future proofing yourself, you have to think long term. You have to be able to see past lunch. Real estate, in my opinion, is the greatest holder of value that you can possibly have. Again, I don't care if it's land. I don't care if it's mobile home parks. I don't care if it's multifamily, single family, commercial, industrial. I don't give a rip. All I care is that your money is in something tangible that cannot be stolen. That holds value. That's what's important to me.
Obviously, I agree with you. But I do have a question. Mm-hmm. What about the people, because you're talking to business owners,
business owners and anybody who wants, even if you're not a business owner yet or want to be, just anybody who wants to take control of their future and not have somebody else controlling it for you.
Yeah. This is kind of probably actually a silly question, because if you're a business owner, you probably have a good work ethic and you have, all the things. But what if because real estate is a skill set, just like owning a business or whatever skill set it is. What if you don't have the time to develop that skill set and to do the research and learn? Because you can't just walk up and just buy a house.
Right.
I mean, I guess you can, but
not well.
You want to do it right. Yeah. What if you don't necessarily have the time or the energy to put into learning real estate?
That's when you have the opportunities to partner with people who you get to be an owner alongside, or you can gain education through someone.
Okay.
It can be learned so quickly comparatively to just passing your money off and then not thinking about it.
Yeah.
That
it's definitely worth the time investment.
Yes.
Yeah.
You're going to see a huge return in your time.
Yeah.
Or a huge return on your money from the time in comparison to the time that you put in.
Okay.
Yes. So that's absolutely a thing. It's also funny to me that most business owners suddenly find a way to learn the thing that's important for them at that time.
Yeah.
Right? They're not typically a victim of their schedule like a lot of other people are.
Yeah.
So it just comes down.
That's about to be me. This year when I have to buy a house, because after
another one,
another house after the tax situation last year.
See?
I don't have time to learn real estate, but I'm going to be learning it.
Suddenly you have time.
Yeah, suddenly I will have time.
It's usually that first tax bill that everyone's like, oh, I should prioritize this and be ahead of it. Exactly. And again, I took all that benefit out of this scenario.
Yeah, you're just talking about,
straight up value hold. So real estate continues to be, in my opinion, the greatest investment that you can possibly make for a future value hold. And then you can just add in all the benefits that I got rid of.
Yeah.
Oh, it can pay you every single month if you so choose. Oh, it also protects the income that you make through depreciation and maintenance and improvements and things like that. Oh, it also has the ability for me to create debt, which is another type of money that protects income, right? Whether you're paying interest on it or whether you are harvesting from that equity and then just putting that money in your pocket to live. Like, it's essentially a way for you to become your own bank in the long term. Done responsibly.
Yeah.
Done responsibly. I'm not saying you go out and over leverage and ruin your life. Done responsibly. These are all options within real estate because banks and other lenders know this is a true, valuable, tangible asset that is consistent that I can count on. Does real estate always go up? No. Does it matter? Not particularly.
Yeah.
Not particularly. The reason being is if you're holding for long-term value, there's no reason that you should be looking to sell in a panic or anything emotional. This is simply a store of value.
Yeah.
That's my whole goal with the real estate.
Unless you buy it astronomically horrible, like just you buy it terribly.
And then it's taking money from you every month. And,
there's no reason that you should be worried about the short term.
Right.
Like what if next year I break even instead of making money? Like,
yeah, and it needs to be, obviously needs to be bought right.
Yeah.
Which comes to the education piece of like storing value for the future involves knowledge and education.
Yeah.
Ongoing education. So that's real estate. That continues to be my favorite. What is another way that people can save for the future that isn't necessarily a traditional route that is limited and or controlled by somebody else? In my opinion, I want to talk about a few of these. Is my second personal favorite is whole life insurance policies. Now, many people will call this infinite banking or IBC or a number of different acronyms and names and things. But at the end of the day, again, store of value with options in the future for me to use it while it's still going to work. In the real estate example, if I pull from the cash flow from a rental, right, it's still going to work. My money is still going to work. My 100 in that example that I put in is still growing with appreciation, being protected through depreciation, and hedging against inflation. It does all the Asians.
Asians. I was about to say that's a lot of Asians.
It controls all the Asians. It's on the right side of all the Asians. Also, it happens to pay me every single month, right? So my money is working twice.
Yeah.
Pays me every single month, also increases in value.
Yeah.
That is a key principle that I want to be practicing. How does whole life do this for me? Okay, I have the ability to put money into a whole life insurance policy. I can own the policy through a mutualized company, and then I have the ability for that cash value to grow from my insurance policy. Now, most people might be thinking, okay, like, how is that an investment though? Yes, you have death benefit and you have principal or premium that you need to meet every year, but we see it as an investment. The big thing for whole life insurance policies, what it does for me is it is, like real estate, recyclable. Let's say I have $100,000 in cash value in a whole life insurance policy. I have the ability to go to the insurance company and go, I want my $100,000. They will give me a collateralized loan against the 100. Okay. So I now have $100,000 in my pocket, tax free, to do what I wish. I can go invest it. I can go have it working in 2 or 3 places at once. But here's the key. In that whole life insurance policy, my 100, that's gaining a few percent per year net, right? It's growing, it's compounding, has a compounding effect, positive compounding effect, because it's growing just like a traditional retirement account. It's still working off the 100 because it's a collateralized loan. The money never came out of the account. That's what's such a key here. So the 100, let's just say it makes 5%. The next year it'll be 105. The following year, 5% above that. Next year, 5% above that, just on like a flat 5% growth line, right? So it's compounding. Meanwhile, the 100 that I took out never actually came out because it's a collateralized loan from the insurance company at a lower rate than whatever my policy is growing. I own the policy. I get to do what I want with it. I then have that 100 go out and buy me a piece of real estate.
And then that real estate is not only...
Let's just say it earns 5%, a terrible return.
Yeah.
Let's just say it just does 5%. My money's now making 10 with probably a net of 7 or 8 due to the interest on the insurance loan.
Yeah.
But it's now working in 2 spaces. Again,
well, yeah, because the
not
value
counting depreciation, cash flow, appreciation, all the Asians, not counting any of them.
Okay.
Value hold in 2 spaces now.
Yeah.
Now we're compounding in different spaces. This is why whole life is so powerful to me. But the principle is recyclable. If my money goes out, I have to be able to get it, but have it also continue working on wherever I decided to put it. So whether that's in real estate, whole life, I'm about to go over another one. There's different options out there that you can go get your money, still use it on whatever you want, preferably assets, but once you become your own bank, you can live your life with it. You can spend it on liabilities, whatever you want, once your bank is large enough. But that's the key. The key is recyclability. If I put my money out somewhere, I have to be able to touch it still.
So the theme is recyclability.
Recyclability.
Okay.
I don't even know if that's a word.
Yeah.
Is recyclability a word?
I don't know.
It's level of recycliness. I like recyclability.
Yeah, just go with that.
I want to be able to put my money somewhere, still be able to have access to it, and have it still work where I originally put it. That's my key.
Okay.
Everything that we do has that ability. So
you said there's a third one.
There is a third one.
I didn't know this.
Yeah.
Do I know this? I don't think I know this.
There's multiple other ones.
Okay.
There's just not as good, in my opinion. So let's just talk traditional for a second. I don't care if it's a Roth. I don't care if it's traditional. Let's just talk about the 401k for a second. No tangents, I promise.
Okay.
No tangents.
You have 30 seconds. Ready, set, go.
Okay.
Kidding.
The problem with traditional retirement accounts is the money goes out, right? Whether it's taxed yet or not, I don't really care. The money goes out, you lose access to it.
Yeah.
Someone else is controlling it, and you're either penalized for taking it. Now, people might say, like, well, after 59 and a half, you're not penalized. It's fine, but you're still taxed, depending on whether it's Roth or traditional. Let's just say you're 30 right now. If you can't touch it for 59 and a half until you're 59 and a half without penalty, that's someone else's money.
Yeah.
30 years. You can commit a major crime and get out of prison before you can touch your money. Your money is in federal prison. That's ridiculous. You cannot touch the money without penalty.
Not only that, but you have no idea what they're doing with your money.
Oh, no, you got to circle the box on your HR. I want to be aggressive, safe, or ultra aggressive because they look at you as a child. And the HR person doesn't know what they're doing either. But I'm dangerously close to tangent there. I won't do that. My point, money goes out. You no longer have access to it. Now, some people will say, well, I can take a loan against it. Fair. Very limited number of what you can take the loan against. You can't take a loan against like either your full value or a high percentage. And typically, you're only allowed to take a loan against whatever you specifically have put in, not the actual growth. That's another problem. Also, when the money comes out, you kill your compounding growth. The second you crush compounding and the second you stop compounding, you can't catch up. You don't have time. The whole point of compounding is time.
So what, are you just not supposed to touch the money until you're dead?
It's in prison.
Yeah.
It's in prison. So if you don't take it out till retirement time, which some people are able to do, say it's 65, they have until 65 until whenever they're gone to spend it. But they also have rules in place. Let's say you're not taking out enough because that's how they get their taxes. That's how they get their income. There's actually a rule in place that you have to start accelerating your withdrawals to increase the tax for them. So
you can keep paying them.
Correct. That's because
after they had your money for at least 20 years.
That's because it's not your money. It's Wall Street's and the government's.
Oh. Okay, no more tangent. They get the point.
It's not your money. So, but the whole point of that, the whole principle behind that is control. The second you put it into a traditional retirement account, you give up control. It's a little improved if it's self-directed, but not a lot of jobs offer self-directed. Almost none of them.
Yeah.
So I don't want to talk about it a ton. It improves a little bit upon self-directed, but you still can't touch it. That's the problem.
Yeah.
You can't get access back to it. There's no real life cell in a spreadsheet typically. So like if you're watching other channels or if you're watching other educators and the second they pull up a spreadsheet, I'm out. Because they're like, if you just do this from the age of 22 to 60, you should have $4 million in your 401k. But the problem is that they never put real life into it when you have to take out of it at some point, when you had hardship, when you have a situation where you need to invest in another area, you have a sickness, anything in life that stops the second of that compounding, that number is figmental.
Yeah.
So you just have to live perfectly for 40 years for that spreadsheet to make sense. That's what makes me sick about it. That's why it's always confusing to me that you might see a channel or an educator say something like that or show a spreadsheet like that. You should have this. But then they go into the numbers of the actual data and say the average 65-year-old, depending on where you look, there's a million different places you can look, The average 65-year-old has $160,000 in their 401k. You're not going to retire on that. That's before tax.
Yeah, it's before tax also.
So their solution doesn't make sense in the true data because the real life isn't plugged into the scenario.
Yeah.
All of our investment vehicles have real life baked in to the whole strategy. Whole life covers an unfortunate death. It covers sickness and illness, and you have ability to go get the money out, and and the growth within the policy is tax-free, so there's tax benefits. The real estate, you have the ability to sell, keep rented out, continue the cash flow. There's just a bunch of different options between those two, and that's why we base our wealth cycle off of those two items. So there is a third, though.
Okay.
There's a third. So the third one is index funds.
Okay.
That's my third favorite one. So most people think of mutual funds, traditional stocks, options, things like that. That's all fine. That's all fine. So an index fund, let's say you have a conglomerate of companies, right? You can buy multiple companies in a single fund. I believe is one of the greatest investments that you can possibly make because they are slow, stable, and consistent. So as an example, there are certain stocks that you can buy and certain funds that you can buy that have every company on the American stock market in it.
Okay.
Like a VTA, I'm gonna say letters and mess it up. VTSAX or something like that. So that's a Vanguard one, but like you can look at different there's a number of different index funds that have different minimums and maximums and things like that. But overall, don't pay attention to necessarily like the specific example of like which index fund. This isn't an index fund picking like podcast.
We're not giving you advice on that.
Yeah, my point is the principle behind it. If you buy index funds, you get to ride the market. Now, the market, okay, over the past 45 years or whatever it is, has gone up on, like, I think over the course of that 45 years, like 11.5%. Somewhere in that range. That's amazing. So whether you are buying at the bottom, buying at the top, the whole mindset behind this is what again? Value hold, right?
Yeah.
So for value hold and I want to be able to have access to my money, we're going to go over how you can do that with this. So if you have index funds and you have growing index funds, so let's say you put $100,000 into index funds over the course of a period of time. Let's say you need a portion of your money. You can go to basically any bank and go, I have this in index funds, and they will give you a loan against it. Now, when you get a loan against it, a collateralized loan against it, what happens? The money stays where it is at. It is still growing. Exactly.
Yeah.
So if I need $60K for something and I have $100,000 in index funds, I can go get the $60K tax-free because it's not income, it's technically debt. And then that money can be paid off by the appreciation and the growth in the cash from the funds, from my investments, right? Recyclable is once again an area in which I can put money in, still have access to it if I want to, and it'll still be able to grow even if I have to go get it for some reason.
I didn't know you could borrow against those.
Oh, yeah.
Okay.
Because they are a hold of value. They're very consistent. They're slower than most, right? So you think of the S&P 500, right? So the S&P 500, most people see that as like the gold standard if you can beat the S&P. So the S&P, say, grows 7 or 8%.
Yeah.
That's your money growing at 7, 8%. That's a good measure of the market, right? If you have $100,000, banks are very, very conservative, but they are very willing to lend against, collateralize your index funds because they aren't usually the item that is, it's not an individual's stock bet. It's not NVIDIA, like if you're waiting for it to crash or grow or whatever.
Yeah.
So it becomes recyclable because of that point. So you have the ability to borrow against an asset that you have tax-free while it's growing. Now, why is this like third or fourth on my list versus like a real estate or a whole life?
That was my next question.
Oh, that's your next question?
Yeah, I was going to ask, why is it third?
Because it doesn't quite have the benefits of the other ones.
Okay.
So real estate's on all the right side of the Asians.
Yeah.
Depreciation, inflation, appreciation.
It's also a physical, tangible item.
Physical, tangible item. Can't be sold. Yeah, exactly. Whole life has tax-free growth. There's,
death benefits.
Death benefits. Yeah, there's other benefits involved. An index fund, you're going to be taxed if you take it out, right? So it doesn't have the tax benefits. Yeah. It's a great hedge against inflation. One of the greatest hedges against inflation on the planet is stocks. So that's why if there's heavy inflation, people see their 401ks grow and they go, oh, I did so good. except you're getting taxed on the harvest, so you're going to lose it later.
Yeah.
They're always going to have a way to get it because you've lost control. I always see the 401k as more of a talent retention tool for companies, not an investment placement for an actual employee.
Yeah.
And the reason I say that is because, one, the employee loses control. But two, many people think like, oh, they give me free money. It's a free match.
Nope.
But it's mind-boggling to me to think that you could go work at a S&P, like a Fortune 500 company, and think that they're flipping a coin on like, well, they're going to be more expensive if they actually do the 401k because we'll have to match it. No, they bake it into the investment into you in general.
Yeah.
So if you don't invest into your 401k, what ends up happening is they get a discount. It's already baked in. So you can go negotiate that. I would be negotiating that. Hey, instead of a 401k match, because I'm not going to do that, why don't we raise my salary? Because I already know you got that expense baked in. That's why you're hiring.
Yeah.
I'm not saying that's exactly how that conversation would go, but
Maybe in better terms, but yes.
But my point is,
Yeah.
if they know that they're going to be paying $120,000 a year because you're going to be matching into a 401k, they're not flipping the coin on that. They're going to offer you 80 and know that the last 40 is going to go into investment.
Yeah.
So why don't we go get that extra 40? Control. So if you're a business owner, somebody who wants more control, or somebody who wants to own a business, or honestly just grow richer than what you are right now, these are some of the options that you can use. And on the index fund side, it's a great hedge against inflation. It's not going to do much for you in other tax benefits.
Yeah.
Though. That's why I kind of see it as third or fourth.
It's still a great option though.
Oh yeah,
Yeah.
because it's super consistent.
It's honestly like, yes, real estate is like the best one.
Yeah.
But like the question that I asked, what if somebody doesn't necessarily have time at the moment to like invest their energy into real estate? Like that's a good second option.
Yeah, absolutely.
Yeah.
Yeah, some of these options can float around for you as long as so to your point, let's say you're working 100 hours a week.
Yeah.
And real estate is just not even on your radar whatsoever. And you don't even want to lend passively, which I'm getting to. You don't even want to lend passively for benefits or anything like that or be part of a fund. Fine. You can still look at life insurance.
Yeah.
You're still going to need life insurance, right? So the whole life becomes a serious option for you. And then also on top of that, if you want absolutely no brain thought whatsoever, networking, nothing, go buy some index funds consistently over time. And just think the mentality that you need with index funds is I buy today and I never look at it again. I just let it ride and I continue adding to it. I continue building my portfolio. And when I want access to it, I have the ability to borrow from it, and once I get rich enough, I can start practicing the buy, borrow, die method.
Buy, borrow, die?
Buy, borrow, die. Once you reach enough wealth, there's no reason for you to earn income ever again because it's just taxable.
Oh, okay.
So you buy assets, real estate, index funds, whole life, whatever you want. You borrow against it. That's your income. It's not taxable because it's debt. Let the assets pay off the debt. And you live your life however you want. And when you die, your accounts are consolidated.
Okay.
You never have to pay taxes again. It's the most American approach I've ever heard in my life. And that is why we practice it.
Perfect. So let's talk about you.
Let's talk about me. I want to talk about, how's that song go? You can sing it. You've been singing for the past 3 weeks before the podcast starts. So would you like to sing
I
the
actually
entire
posted
song?
a video the other day and everyone thought it was really funny of me singing into the mic. Whenever he tests the mic over there, he's like, please, so like snapping it or something. I start singing in it and it drives him up a wall.
Oh my God. Yeah, you can sing this.
Okay, you
Yes.
run me through, spark notes me your investments and
Our finances.
Yes.
Okay. So no matter where our income comes from, we have percentage breakdowns, okay, of where the money is to go. So it doesn't matter if we make 100 grand in a month, 500 grand in a month, million a month, doesn't matter. We're going to have percentages that are broken out. So if I make 100 grand in a month, 20 grand's going somewhere. If I make $1 million in a month, 200 grand's going to that same place. Okay. So the first thing we do is we do a 20% self-pay.
Okay.
And the way that we do self-pays is we break, specifically how we start it is through whole life insurance policies, because it gets to that first point of recyclability. There's that word again. So if I have 20% at minimum going into whole life policies, what I can do is I can have my wealth standard there, or stored there, I should say. That wealth is stored at that point, and I can go get it at any time that I want. It's not an application. It's not this big, long process. I fill out a piece of paper. I sign a piece of paper. I send it to the mutualized insurance company that I'm working with at the time. They send me my funds. They wire it to me. I can then use those funds on whatever I want. So the first thing that happens is a 20% self-pay, and it starts with whole life. It can then be distributed to real estate, index funds. Something that we're building right now is a lending branch, which I'll get to in a few minutes. We always have room for something new to be tested and tried.
Okay.
To try and get obviously larger returns, protection. We look at our whole portfolio of capital and we go, this is protected through equity and debt, and this is protected through insurance, and this is protected through, borrowing against, this is protected, we look at protections first and then we go from there. So if we see an avenue in which we have excess, we'll look at new branches or opportunities, and one that we're looking at right now is lending. So D has basically set up a lending branch. So we have lending going out.
Yeah. And
then we see how the interest return is. That's part of our wealth cycle, is adding assets to our cycle over time. That way it just adds more money to our banking system.
Okay.
Now, let's say in that example when the lending comes in, doesn't matter where the lending comes in from, right? 20% goes to whole life. So it always cycles back around and hits us. And then we choose what to do with it. So 20% always goes to a self-pay that is protected and has the ability to grow. We have a forecasted expense account, which is used as a personal checking account. But so every single month at the end of the month, for the following month or the upcoming month, we have a very specific amount of money that is placed into it automatically, wires into it, and that is our forecasting for the month.
Yeah.
And then we try to live on that for the month. And then if we last until the 6th of the following month, we know, what are we doing? But the reason for that is, could we pay ourselves more into our forecasting personally every single month? Yes. But should we?
No.
The reason
you don't need to, no.
Yeah, the reason that we do it is because it puts boundaries on what we're doing. It keeps us building the rails of productivity and moving forward, and creates building a bigger and bigger moat and more protections and more investments that grow faster. Because if I just took all the money every single month that all the businesses make and we just spent it every month, we would be in the same situation as somebody living paycheck to paycheck. We would just have a different lifestyle.
Right.
And there's no point to that. That's why the whole point of this episode is to talk about how business owners and people who want to be business owners and or live differently can take control and actually save for the future that goes to work for them every single day, and you still have access to your money. So we have a forecasted amount that comes into our personal checking every single month. Our goal is to live on it till the end of the month. We almost never do it, but we get close.
Yeah.
But we get close. So we might have to add a little bit by the end of the month, but that's usually because we're trying different experiences, or maybe even we make a different investment out of it. But the whole point of that is for it to stay in the personal expense account. We even call it an expense account. It's meant to go to zero every single month. So that's another portion. The rest can get reinvested into the businesses. So if the real estate portfolio, it's its own wealth cycle, it's its own business entity, right? So that business creates an ops account, a growing ops account. It creates an investment account. It pays contractors or employees. It pays for renovations. It pays for its own improvements. It operates on its own.
Yeah.
That's the whole goal of it. Because what is real estate? It's a value hold. So if it operates on its own, the longer it operates on its own, the more valuable it becomes. I can then look at the portfolio over a period of time and go, how can we maximize this? Well, maybe it's time to sell a portion, use a 1031 tax benefit, roll it into something more valuable. There's another one of those Asians. that real estate's on the right side of. Like, it has so many options. Hedge against inflation. On the right side of appreciation. Protects your assets through depreciation. Like, it's the number one asset. It really is. So while this is operating on its own, we will look at it periodically over time as we either add to it, or if we want to subtract from it and move something to another area, we have the ability to do that. But again, what does 20% of it do? Self-pay.
Self-pays, yeah.
Always self-pays. Always self-pays. So it has to self-pay and be able to operate on its own. Same with our publishing company, same with our education company. All of the companies have the ability to pay us at least 20%. So the margins have to be built in a way that we can always get a 20% self-pay, in which that money's always going to work and growing, because time becomes an asset for us then. So between the two biggest principles that you need to follow if you want to save for the future as a business owner, control. You have to keep control. You can't give control to somebody else.
Yeah.
And number two is you have to create time as an asset. It can't be a liability. So the more you're doing something, the busier you are, your production's actually going to get worse over time as you get older.
Yeah. You can't just constantly rely on the fact that you can always make money or always have more time.
Exactly.
Yeah.
So as time goes on, time's actually becoming a liability because your time's getting short. Your time of productivity is getting shorter.
Yeah, but if you're putting your money into, say, whole life policy, you're buying your time back. Like
or real estate or
real
index.
estate, anything. Yep. Anywhere you're investing your money and it's paying you, you're earning your time back.
Exactly.
Yeah.
You're actually buying time as an asset.
Yeah.
Because the longer time goes on now, the more time something has, the more opportunity something has to grow.
Yeah.
And your life gets better every single day financially because of this item. So whether the markets go up or down, sideways, consolidate, it doesn't matter. Your net worth will actually be increasing because over time, your assets have the time to fight against inflation, hedge against inflation, have the time to appreciate and grow and be productive without you having to go to work for it every single day. And all of these things can start to happen without you being involved in them on a daily basis. These all become repeat incomes, right?
Yeah.
So if you can get to an area where you have 7 figures in repeat income, not even just necessarily passive, repeat. Difference between passive and repeat. Passive, you truly do nothing for it. Example I have is book royalties and lending.
Yeah.
Interest just shows up. Royalties just show up. Repeat is more so your real estate because you have to manage.
You have to do something.
You have to manage the asset in some shape, way, or form. So a dividend-paying stock, it's pretty passive.
Yeah.
So those are different examples. But you can get that to 7 figures faster than you would think because you keep your control. And you're actively pouring into it because it's an actual long-term strategy. You're seeing past lunch. You know exactly what you're supposed to be doing. And it's laid out up front like, 20% is going to go to my self-pay. Once that gets to a certain level, I'm going to reallocate portions of that to different investments. And now it's going to be working in 2, 3, 4 spots at once.
Yeah. So if you are a business owner and you're finally getting to the point where you can think about it and you're like, okay, I should be thinking about my future. I have the time now that my business is like successful enough to think about my future.
Yeah.
What's the first thing they should do?
I would spend it on education.
Okay.
I would spend it on figuring out where you actually want to be involved at.
Okay. So that's what I was going to say, just not in such a fancy way. I was going to say, think about which option might be best for you and your lifestyle and your time.
Yeah. Which one actually resonates the best with you?
But you have to educate yourself to do that.
Yeah. We put this into like a 1, 2, 3 best option, but in reality, those are the 3 best options. So as long as you, in my opinion,
at least one of them,
getting one of them.
Yeah. Because if you choose, especially if you choose index funds or whole life, you start there and they're less involved. You can take the money in there and go buy real estate later.
Yeah.
Yeah.
Yep. So I would say that some of the biggest things to watch out for is that whoever you're learning from, whoever you're partnering with, or whoever you're buying through, you have to make sure that they're honest, ethical, and moral.
Yeah.
So,
because that's the control thing. The control thing comes right back.
Yes.
If you're working with somebody, that's part of your control you're letting go.
Exactly.
Like, yeah.
So I would say the simplest one there is probably the index fund because you can just buy it through the market. You don't have to be a partner with anybody.
Yeah.
If you were, I would recommend going through a Vanguard personally because their fees are the lowest.
Yes.
I won't go on a 401k tangent and fees, but you want to look at your fees. Your fees have to be as low as humanly possible. So if you're going to go through, say, a Vanguard, to my knowledge, they have the lowest fees and continue to. So I would say both whole life, and I can actually help you with the whole life. So the whole life, you can build your policy through Who Builds Ours. I actually have no problem sharing his information. I can put it in the description down below.
He's pretty great. He does mine too.
Yeah, but I've known him for a decade.
Yeah.
And highly trusted. Like there's a reason I go through him.
Yeah.
Right. So, but even then, just because I'm saying that, you should still vet, build a relationship, and be involved and go through the process.
Yeah, and be aware.
Yeah,
be in control.
Yeah, I can
Don't
share.
just do it because somebody else said to.
Yeah, I can share his information down below. I've been doing it plenty long, and he's done a wonderful job for us. And on the real estate side, you just got to make sure you're learning from somebody who has your best intentions.
Yeah.
Not somebody who's just looking to sell a course or looking to sell information and things like that. Look for somebody who's practicing, actively practicing what they're
And
talking
they're
about.
ethical. They have good morals.
Yeah, as long as they're, which is typically going to come from practicing. Like as
Yeah.
long as they are practicing what they're actually talking about,
Yeah.
it's usually a really good sign of that's somebody that you can be alongside to some shape, way, or form, to at least some degree, and learn something from, and then be able to take what they're learning, make it your own, and be able to be profitable from it.
That's good. Yeah.
So I would say those are the biggest three. Have room for a fourth or a fifth. Have room for creativity. Like you can invest in businesses. If you want to do gold or silver, that's really up to you. That's, it's a hard asset that's slow moving. But you know what you can do? You can get lending against it for sure, because it has a consistent value. Like there's different things that you can do that you can allocate funds to and still have your control. And that is my goal in talking to you about this today, because I just want you to keep control. I want you to have the ability to go get the money that you invest and replace it somewhere else if you need to, and continue to have it grow where you originally put it. That's it.
Yeah, that was really good. And I think you describing what you guys do is kind of helpful too.
Yeah.
I think honestly, you could do a whole episode just on that.
Yeah. Oh yeah. We could get really, really deep into that. The principle wise, it's really simple.
Yeah. You really highlighted the principles very well.
Yeah. I mean, I could spend 40 minutes on how each dollar gets rerouted. And
but
things
either
like that,
way, it's going to be different for everybody, because everybody's lifestyle is different. They're like the amount of money they need, what you make, where you're going to allocate it. It's going to be different for everybody.
Yeah. How much should I have in my self-pay before I invest above and beyond that? I mean, some people are going to be $5,000. Other people are going to be $250,000.
Yeah.
It really depends where you sleep. We call that our sleep well number.
Yeah.
So wherever you sleep well is the amount of cash or immediate access to liquidity you're going to want to have. And then you're going to go invest in long-term value stores above and beyond that.
Yeah. Yeah.
So it really depends on the person. Maybe we'll have to have a discussion about like what kind of pairing the people to that. Because there's some things that you can follow and kind of put that on rails. Where somebody, as an example, engineered brain, it's very fixed, right? So they're going to have a very specific number that has to be there no matter what before they're willing to risk another dollar above and beyond.
Yeah, they're also probably not going to do it how you do it, where you're like, oh, we'll put this much in the account. We'll try to strangle it together, see if we can make it this month, and then they're not going to like that.
No chance. Yeah, no. That's too fluid.
Yeah.
They're going to have like more things that are set up and really rigid, which is fine, which is cool. That's the cool part about it. That's why we talk about principles and not. That's why you didn't see a spreadsheet pop up on the screen, because you can't live off a spreadsheet.
Yeah.
You just can't. They're great for looking back on.
Yeah, to understand your patterns and your growth and such, but they're not good to plan with.
I have not seen one yet that is a good example for people. They're really good at getting attention and views and excitement. Well, if you just did this from 22 to 50, you would have this. Sweet.
Great. So what
happens if I have 3 life events that happen between 22 and 50? Now my $4 million is $600.
Yeah. Yeah.
So I won't go on no tangents.
No tangents.
No tangents. I love you guys. Thanks for hanging out.
Hope you learned something. Hopefully this was helpful.
Yeah, hopefully it's helpful. Hopefully it's something that you can apply today. And then you can let us know how it's going. And if you have questions, you can always put it in the comments.
Yes. Thank you.
We'll see you next week.